Just over 6 months ago in November, Microsoft's price to earnings ratio was amongst the highest 30% of stocks in the entire software infrastructure industry. But since then, the stock has dropped and the picture has completely changed. In this video, we'll look at Microsoft's valuation today so you can understand whether it represents fair value by looking at the actual fundamentals. I'm Charles, I've been building stock market analysis tools for 8 years, and I run HelloStocks.ai, whose top scoring stocks have been beating the market on average since launch. And let's not waste any time, because we all know Microsoft's core business is super strong. Great margins, huge free cash flow, low debt, and its growth has also been relentless. Strong revenue and earnings growth pretty much year after year after year. So what I want to dive straight into with you in this video is the valuation, because that's what sets this stock apart from most of the Mag 7 right now. This is Microsoft's PE ratio from that October-November period right through to today. And this right-hand chart shows where that PE ratio ranked against other stocks in the same industry. In November, Microsoft was almost touching 40 PE and amongst the highest 30% of stocks in software infrastructure. But since then, it's plummeted down to the mid-20s. But look at this. Microsoft's PEG, their price earnings to growth ratio, is sitting at around 1.5. The PEG ratio is like a superior version of the price to earnings. It takes the price to earnings and then divides it by the expected annual earnings growth rate. What that means is it values a stock based on its price today versus how much is expected to grow its earnings into the future. And it's generally a much better way to value a stock, made popular by the legendary investor Peter Lynch. Typically, a PEG below 1 indicates undervaluation. Between 1 and 2 is a fair value stock, and above 2 becomes increasingly expensive. Which means this 1.5 figure for Microsoft puts it bang in the middle of fair value. But wait. There's something else very important to consider here, and it's not getting talked about enough with Microsoft right now. So I'm very happy to share it with you, because the PEG needs two numbers: the price to earnings, and then secondly, the expected annual earnings growth rate. But that annual earnings growth rate is a forecast, an expectation. For Microsoft, we have the average expected growth rate figure provided by market analysts, which is 16.5%. Now that's an interesting number, especially when we take a look at what Microsoft has been achieving in the past. Because Microsoft compound annual earnings growth rate over the last 5 years was 18.8%, and over just the last year, it was a huge 29.8%, both quite significantly higher than the expected future growth rate of 16.5%. Now, of course, past performance doesn't guarantee future performance. We can't just simply say that because they achieved almost 30% earnings growth last year, that they will go and do that again this year. But if we look at their latest quarterly earnings results, we can see that they beat expectations. We were also told that they have a $627 billion backlog in demand for their cloud services, Azure. That's a 99% increase year over year. To put that into context, Microsoft's backlog demand is worth more than the entire market cap of IBM, Salesforce, Dell, and Adobe combined. So, we have a situation where Microsoft have been growing faster than that 16.5% number in the past. They are beating earnings expectations right now, and they have one of the largest customer backlogs of any company on earth, which they are going to be fulfilling in the future. And all that makes me think this 16.5% annual earnings growth expectation is likely to be on the low side of what will really happen. And here's the cool thing, and the whole reason I wanted to make this video. Even at that 16.5% growth rate, Microsoft is still fairly valued right now, but anything above that, let's just say a modest increase to 20%, well, that would bring the PEG way down closer to 1, which, for a company as established, as strong, as profitable, and is well placed to take advantage of the AI revolution as Microsoft is, would appear to be extremely good value.